For today's event, Planning for Your Financial Independence, featuring financial wellness coach and New York Torero Club committee member Erik Carter, class of 2009 JD. My name is Megan O'Rourke, and I'm the Associate Director of Regional Programs for the University of San Diego Alumni Association. I hope you all are doing well and staying safe and healthy. The mission of the Alumni Association is to engage and enrich the Torero community for life. Today's event was created to provide programming that is of the greatest need to our alumni while supplying resources to better their lives. We hope you leave today with some more tools in your tool belt and the desire to take on the next financial step in your life. The session will begin with a welcome from New York Torero Club President Christina Liu before we hand over the mic to Erik. Friendly reminder that we are using the webinar feature and have activated the Q&A for you to ask Erik any questions that you may have. We will spend about 10 to 15 minutes at the end for Q&A if we have the time. At this time, I'd like to introduce New York Torero Club President Christina Liu to turn on her camera and address the group. Christina?
Hi, good evening, everyone. On behalf of the New York Torero Club, I just want to say thank you for joining us today. We're super excited about the event. Just want to introduce myself. My name is Christina, class of 2010. I went to USD majoring in philosophy and minoring in marketing and Spanish. I'm your New York Torero Club president. And I just wanted to actually take a moment to recognize and give a shout out to the New York Committee Club members, Lucia, Evelyn, Erik, actually, who is presenting today, as well as Kevin for their time and commitment on the committee and planning these events and trying to build the community here in the New York chapter. For those of you who aren't as familiar, the purpose of our club here is to really connect with current students, connect with New York alumni, and really build a community out here on the East Coast, also with the university. There are a ton of events that we try to plan, usually about 6 to 7 a year, this being one of them. And just for your information, for the past couple of events, we've done everything from a nutritional webinar to yoga to financial planning to just get-togethers via Zoom and also in person. If you're interested at all in participating with the chapter, the committee, we're always open to volunteers. You can feel free to reach out to me after this. Happy to connect. And if you also have any suggestions on events you'd like to see more of or less of, or any kinds of comments or insights, also open to hearing what they are. Without further ado, I just wanted to introduce Erik, who is our speaker today. We really hope you enjoy the session. He is, as Megan mentioned, class of 2009. He is a New York, not only a New York Club committee member, but also a lawyer, financial wellness coach. And he has actually provided a lot of financial advice and guidance to a lot of successful people in politics, modeling, businesses, professional life, you name it. And he is a regular contributor to Forbes, as well as providing commentary on numerous branded publications and media outlets, including CBS News, Fox Business, as well as CNBC. And without further ado, Erik, welcome. If you can please turn your camera on, take it away.
All right. Well, thanks a lot, Christina, for that introduction. I am, as she pointed out, a fellow alum from actually USD Law School. So I was a financial advisor before I attended USD, and then decided to get my law degree really to focus more on learning about tax and estate planning to round out my financial planning knowledge. And what I want to do today is share with you, some of the key tips and strategies around planning your financial independence, which is a word that I prefer over retirement. We say how to make your dream retirement a reality, because really, I think financial independence is the idea of working or not working because you want to, not because you have to. Whereas I think people think of retirement as a time to just stop. And I know a lot of people, including myself, may never want to, right? But it is getting to that point where you have more financial freedom. So first thing to think about is, what is your goal when it comes to financial independence? In other words, if you didn't have to wake up to your alarm clock and go to work anymore, what would you do with your time? And if you've never just had fun and did a little daydreaming with that, I suggest that you do that because it's hard to plan for something if you have no idea what that something is. And having that vision will help motivate you to take some of the steps that it may take in order to make that happen. So think about, what do you look forward to? Maybe you want to travel. Maybe you want to spend more time doing volunteer work, starting a business that maybe was a bit too risky to do before you were financially independent, or working in a career that maybe wouldn't pay the bills today. Or just spending more time with family and friends, right? Whatever that image is. And then think about, how much is it going to take? How much money will you need? Now, if you have no idea, typically financial planners say on average, people need somewhere between 70 to 80% of their current income when they retire, or right, when they want to stop working. And the reason people generally need less is, first of all, you're not going to be saving for financial independence. So whatever amount of money you're putting away is income you're not going to need. You may by then have a mortgage, student loans, other debts that may be paid off. So you may not have that. Maybe you have kids that will hopefully be on their own. Maybe you plan to downsize or move to an area with a lower cost of living. So a lot of it depends on your particular situation. And then when do you want your financial independence to begin? And if I just asked you that question, you'd probably just say today. But we're going to talk about how you can see realistically, how soon you can make that happen and what you need to do now to make that happen. Now, first step is to run a retirement estimate. The idea here is, not for precision, because nobody knows for sure what's going to happen in the future, but to get a rough idea if you're on track. Are you saving enough using some reasonable assumptions? So, pick an age that you want to target for being financially independent. And as you're going to see, you can adjust that age as need be. Think about how much income you think you're going to need. Now, don't worry about inflation, because the tool I'm going to use already factors that in, that I'll show you. For Social Security, what you can do is you can actually get an estimate of that on the Social Security website, ssa.gov. I'll show you what this looks like here. So if you come to this site and you click this retirement estimator, you can get an estimate of your projected benefits in retirement based on what you paid in and what you're projected to have paid in. Yeah, you do have to put in your Social Security number and answer some other personal questions. If you'd rather not do that, you can click other calculators. And if you scroll all the way to the bottom here, where it says Quick Calculator, you can just put in your date of birth and your income. And especially if you're early in your career, I think that's totally fine, because there's so many variables. You just want to get a rough estimate of what that can be. So think about, life expectancy. We'll talk about that in a moment. Inflation, what that's going to be, what you have now in terms of retirement assets and savings, and what are some reasonable rates of return. So what I'm going to do now is show you a calculator that my company offers. And actually, we make this available to people for free. And I'm going to put a link to this in the chat box. So anyone wants to access it, and you can plug your own numbers into this retirement estimator. And you can see how you can use this to see if you're on track. So you can either look at it just for you if you're not married, or if you're married, you can also choose to include a spouse or domestic partner. So the first question it's going to ask is, what is your income replacement target? What percentage of your current income would you want to have once you achieve your financial independence? So the default is 80%. So if you're not even sure where to start, you can just leave it at that, since that's kind of the high end of that typical range. You can put in your current age, your target age for retirement. So if you want to retire early, you could try putting in something more ambitious there. Life expectancy, this is how long we need our money to last. To be safe, I'm going to increase that up to 90. And then you can put in your annual salary and bonus. So just for the purpose of this, I'll put in like 60,000. Obviously, you put in your own income. How much you're currently contributing, to your employer's retirement plan, whether that's a 401k, or maybe if you work at a nonprofit, you have a 403b. So for this, I'll put in 15%. If you plan to increase your contribution each year, you can put that amount in here up to where you want to stop it. If you're getting a match from your employer, let's say we're getting a 5% match, you can put whatever that is there, and any other contributions that you get from your employer, you can enter here. And then your current retirement plan balance. Let's say I'm starting with $20,000. I'm just kind of putting in random numbers here. And how you tend to invest. So the default is conservative. Actually, sorry, it's moderate. And that's a 6% average return. You can use, if you're more of an aggressive investor or more of a conservative investor, you can kind of pick the one that fits you the best. And then this is where you could enter your Social Security benefits that you get from that site. Let me just put in random number, what age you plan to start collecting it. If you're getting a pension, one of those that are kind of disappearing, if you're fortunate enough to have one, you could enter your pension info in here. Any other income, like say you have a rental property, you collect rental income, you could enter it. And then finally, if you have other assets, like maybe you have a retirement plan from a previous job, IRAs, we'll be talking about all that fun stuff pretty soon. So once we get there, this is where you can click goal calculation. And you could see that for this person with these random numbers that I put in, they're on track to have a little over 2/3 of their income in retirement. Okay, which ignore this $100,000 income, because in today's dollars, when you adjust for inflation, it's really worth about $41,000. And remember, their current salary is $60,000. So for this person, they may need to either save a little bit more, or perhaps they need to retire a little bit later, whatever that may be. And so when you plug in your own numbers, you can kind of see where you are. And maybe for you, you'll actually be ahead of schedule, and maybe you could retire early or something like that. Let's see if I make it 67. So it helps close the gap a little bit. And you can, again, use this to see if you're on track, and if you're not, what you can do to get on track. So you could try, increasing your savings amount, retiring later, whatever it may be. There is no right or wrong answer to this. It's finding the right balance for you. For some people, they're willing to just save a lot because they want to retire really early or with a large amount of income. And for other people that have a lot of other obligations, maybe other priorities right now, they may save a little bit less, and they're okay retiring a little later or with a little less income. So there's no right answer to this. It's really what works for you. Okay, but the key thing is you just want to be aware. You want to be conscious of what you're currently on track for. Okay, so that you can, make the proper decisions about what you want to do. Now, what if you want to save more, or you're trying to figure out where your savings should go? So first thing I would say is make sure you're putting enough in your employer's plan to get the full match. You don't want to leave any of that free money on the table. So if your employer is matching, in this case, we use 5%, try to put in at least 5%. Okay, if they're matching 6, try to put in 6. Now, once you get past that, you've got a lot of different options here. First of all, if you have high interest debt, I would define that as any debt where the interest rate is higher than 4 to 6%. So credit cards would fall into this category, personal loans, some student loans, if you've got one with high interest rates, may fall into that category. You may want to focus on paying those off first. Why? Because the interest you're saving on that debt is probably higher than what you can expect to earn by investing those savings instead. Now, if you have debt where the interest rate is between 4 to 6%, a lot of student loans are in that category. This is a personal question. If you tend to be more of a conservative investor, you may prefer to pay that debt off. If you're more of aggressive, you may prefer to invest the extra money. But if you have debt where the interest rate is lower than 4%, you're probably almost definitely better just making minimum payments on that debt and investing any extra savings you have. right? So that could be a lot of mortgages, some student loans, some car loans that tend to be very low interest. And that's why they call it good debt. Now, where should you put additional savings? Well, one option that you may not have thought about is an HSA, a health savings account. Now, this is only available to you if you are in a high deductible health plan, okay, where you're able to contribute to an HSA. So make sure whatever health insurance plan you have is eligible. Now, the benefit of doing that is when you put money in that HSA, you pay no tax on the contributions. So you're not paying any tax on the money when it goes in. And when you use the money to pay for healthcare expenses, it's tax-free. And that's healthcare expenses either now or later, including in retirement. So you can end up paying zero tax on that money. Okay. It's got the strongest tax benefits. Other options would be an IRA. This is not something you would do through work. Or you can just have a regular investment account. Okay, so we'll talk a little bit about each of those. Let's start with your 401k or a 403b, depending on where you work. The advantages of these, it's convenient, right? The money comes right out of your paycheck. You may get company contributions like a match. You may have an automatic increase feature where they can automatically increase your contributions over time. And you can put up to 100% of your pay up, but there's a limit, $19,500 for this year, or $26,000 if you're turning 50 or older this year. So that's the most that you can put in pre-tax or Roth. So pre-tax means you're not paying any tax on the money when it goes in. So it lowers your taxes right now, but you pay the tax when you take the money out. With a Roth, you're not getting any tax break now, but after 5 years and when you turn 59 and a half, all the money in that Roth IRA and that Roth account can come out tax-free. Okay, so if you think your tax rate will be lower in retirement, which for most people it is, you may want to do the pre-tax. If you think it may be higher, you may want to do the Roth. And in the meantime, you can take a loan or a hardship withdrawal if you need to. But just know if you're taking a hardship withdrawal, you got to pay a tax, and if you're under 59 and a half, a 10% penalty on that money. So it should only be like as a last resort. So how do you decide whether to put money in pre-tax or Roth? Well, one thing is in some situations, if you can lower your taxable income, you may be eligible for other tax breaks. Like maybe your income is so high that you're not eligible for certain tax breaks. And by putting money into your 401k pre-tax, you're able now to be eligible for those extra tax breaks. So that's a huge advantage of doing that. Also, for most people, their tax rates will probably be lower in retirement. But there may be situations where the Roth makes sense. One is if you think your tax rates might be higher. Maybe you're worried about tax rates going up, or you expect to have more income in retirement than you do now. But there's another reason a lot of people don't think about. And that is if you want to retire before 65, 65 is when you're eligible for Medicare. Okay, so if you want to retire, let's say at 60 or 55 or even earlier, you may have to buy health insurance through the Affordable Care Act, okay, AKA Obamacare. And the subsidies under that plan are based on your taxable income. So the higher your taxable income, the fewer subsidies you get. So if you have income from a Roth account that's tax-free, that means it's not going to count, which means that you can be eligible for lower health insurance costs. So if you think you're going to retire for 65, you may want to put at least some money into that Roth 401k. And by the way, you can split your money between the pre-tax and Roth. You don't have to pick one or the other. It's just the total that you put between the two can't be more than those limits, 19,500 or 26,000 if you're 50-year-old. Okay, that's the overall count. All right, so I mentioned earlier to you about HSAs, health savings accounts. So here's the skinny on those. Like I said, to contribute, you have to be in a high deductible health plan. There are limits, just like there are with the 401k. You put $3,600 a year if you have individual health plan, or $7,200 if you have a family plan. And if you're 55 or older, you can put another $1,000 in. So that's the max you can put in per year. Whatever you don't use, you get to keep in that account. And usually you can even invest money in that account. Just don't invest anything that you may need in the next few years. So unless you have savings elsewhere to cover upcoming medical bills, anything that you could happen, okay, you don't want to be investing that money. But if you've got enough savings to cover, any medical bills that could come up in the next few years, anything above that, you may want to invest for the future, because that money is tax-free if used for healthcare costs now or in the future. Here's another thing a lot of people don't know. If you have healthcare costs now, you can cover that just from your regular savings. Just keep the receipt, because at any time you can reimburse yourself from your health savings account tax-free. Okay, so if you want to leave the money to grow as much as you can tax-free, and you can afford to pay your medical bills with other money, you may want to do that. Just keep the receipt so you can always reimburse yourself in the future. Now, if you use that money for something other than healthcare, you're going to have to pay a tax, and if you're under 65, a 20% penalty. But here's the good news. Once you hit 65, that penalty goes away. So you can basically use it for anything. No penalty. And it's still tax-free if used for healthcare expenses, including some Medicare and long-term care insurance premiums. So think of it as a retirement account, not just as something to pay for medical bills. And in fact, once you get the match in your 401k or 403b, you may want to make that the next priority. All right, let's talk now a little bit about IRAs. This is another individual retirement account. This is another account you can put money on and get some tax breaks. So it's another tax shelter. And there's two types. There's a traditional and a Roth. Now, the total amount that you can contribute, okay, to IRAs is $6,000 this year, plus an additional $1,000 if you turn 50 or older. And you have until April 18th of next year to contribute for this year. So you've got a little extra time for those IRAs. And the main difference here is the traditional IRA, if you meet the income limits, you can deduct the contributions from your taxes, but then you got to pay the tax when you take the money out. With a Roth, you don't get a tax break now, but it can grow to be tax-free after 5 years and 59 and a half. Okay. Sorry about that. This is where I meant to go. One other thing to know about the Roth IRA that a lot of people don't know is that whatever you put into it, okay, let's say you put 6,000 in, that's the max. You can take that money out anytime you want, no tax, no penalty. So say I put 6,000 in today, I change my mind tomorrow, I can take my money out, no tax or penalty. Here's the kicker. If that $6,000 grows to 6,500, so I make $500 in that account, and I take that extra $500 out before 5 years and 59 and a half, I got to pay a tax and a 10% penalty on that $500. There's some exceptions like education expenses or up to $10,000 for a first-time home purchase. But in general, I'm subject to that tax and penalty. But the good news is your contributions, the sum of your contributions always comes out first. Okay, so you can access all the money that you've put in anytime you want, no tax or penalty. And when you turn 72 for most people, unless you already turned 70 and a half, before last year, you're going to have to start taking money out of your 401k, out of your IRA, but not your Roth. So your Roth can grow tax-free as long as you like. So lots of benefits there with a Roth IRA. So one thing people might want to do is, maybe contribute to your 401k pre-tax so you can lower your taxes as much as you can now, and then also do a Roth IRA so you also have some tax-free money. And a lot of that you can access at any time. All right, so how do we invest this money that we have in our 401k and our IRAs, and maybe we have some other accounts? Well, the main decision is how do you split your money between stocks, bonds, and cash? And there's a trade-off here between risk and return. So cash, don't just think of physical cash. This is like, could be money in the bank or anything where it just earns interest. Now, the downside of that is the return is really low, especially right now because interest rates are so low. But the good news is we don't have to worry about it, falling in price the way we do with bonds and especially stocks. Stocks are volatile. They go up, but they can also come down. But the advantage of stocks is in the long run, they tend to earn the highest returns. Okay, but in the short run, they tend to be very volatile. And then bonds and real estate are kind of in between. So this chart kind of gives you an idea of the difference here between these different types of investments. So stocks is that green. And you notice over a 1-year time period, this is from 1950 to 2018, the best year for stocks was 47%, but the worst year was negative 39. And that's why for, in the short run, they're very risky. But look at that, as the time frame gets longer. Once we get to 20-year time periods, the worst stocks did was a positive 6% a year. That's the worst. So that's one of the advantages of starting early or just having a long time frame, is that we can afford to be a bit more aggressive and have more in stocks and get those higher returns as long as we're comfortable with the level of risk that would entail. Okay. And so the other thing that you have to factor in is, how comfortable are you with the ups and the downs? Because it's one thing just to look at the chart. It's another thing to actually experience it. I mean, think about last year. I mean, that was a short time period where, because of COVID, the stock market had plummeted. If you can't sleep well at night when that happens, you may want to be probably a bit more conservative. And in that case, you're going to have less in stocks than someone who's moderate, or especially someone who's aggressive. Okay, so assuming you have a long time frame, like we generally do with retirement, you can see that someone who's more conservative, less in stocks, aggressive, more in stocks. Now, the advantage of being conservative is that you're going to have a smoother ride. Okay, you're not going to have as many ups and downs. The downside of it is that you probably won't earn as much in the long run, okay, as someone who's more aggressive. So that aggressive person will probably earn more, but the flip side of that is that they're going to have a much bumpier ride, on the way. So again, no right and wrong. You just have to figure out kind of what your comfort level is. Now, to make this simple, there are a lot of times, you may see this in your employer's retirement plan, things like target date funds, where what you can do is just pick one with a year closest to when you want to retire. And then that fund will do all the work for you. They'll diversify it. And as you get closer to your target retirement year, the fund will automatically become more and more conservative. So as you get closer to retirement, it gets more conservative. When you're far away, it's more aggressive. So that's another way to kind of simplify things. But regardless, whether you want to build your own portfolio or whether you want to use a target date fund, I want to show you this concept of rebalancing, because this is a way to make the ups and the downs of the stock market actually work for you instead of against you. So here's how rebalancing works. Let's suppose that you decide to have a moderate mix. This is how most pension funds will invest, like 60% in stocks and 40% in bonds and cash. So that's your starting point. Okay. Now suppose that the stock market has a great year and the stocks go up a lot more than bonds and cash. And now the stocks make up 70% of your portfolio. We're happy, right? Woohoo! We like to see the value of our stocks go up. But now we're actually taking on more risk, even if it doesn't feel like it. So what we want to do is move some, not all, but some of the money out of stocks into bonds and cash. We're basically taking some of our winnings off the table and putting that money into that bonds and cash. So this way, the higher stocks go, the more you sell. If it keeps going up, you keep taking money off the table. Because at some point, nobody knows when, why, or how long it'll last, but at some time, the market will go through a significant decline. And when it does, instead of 60% of your money in stocks, you may only find half of your money in stocks, which is what happened during the pandemic. And this time when you rebalance, you're going to move money out of bonds and cash into stocks to bring yourself back up to that 60% target. So the lower stocks go, the more you buy. And if they keep going lower, you're buying more. You're not timing the market. You're not trying to predict the market. You're just trying to keep yourself at that original target. But by doing this, you're following the advice that Warren Buffett gave when he was asked, what is the secret to getting rich by investing? And he said, be fearful when others are greedy, be greedy when others are fearful. So when times are tough, when the market's down, that's a good time to buy. When the market's high, that's a good time to sell. Not everything, because we don't know how long that will last, but by rebalancing, it kind of forces you to do that. And the great news is you only need to do this once a year. So you don't have to look at your account every day to make adjustments. Just once a year, rebalance. And if you're in something like a target date fund, it'll do the rebalancing for you. So really, really simple. Now, there are a lot of different ways of investing depending on how involved you want to be. So if you want to be super involved and very hands-on, you can pick individual stocks and bonds. It gives you the most control, but you really have to know what you're doing. You have to have enough money to be diversified and enough knowledge to do that. ETFs, these are exchange traded funds. It's a way to buy a basket of stocks and bonds. So it gives you an easy way to diversify at very low cost. You can invest in what's called asset class mutual funds. So you're pooling your money with other investors. And then that mutual fund manager is then buying stocks or bonds or whatever it is that fund invests in for you. So you give up some of that control in exchange for diversification within the category that the fund invests in, and they do charge fees, okay? And then you get to premix funds. That's like the target date funds that I mentioned earlier. With a premix fund, you only need one because they're fully diversified. So like a balanced fund or a target date fund, it's a one-stop shop. It's cheaper than going to an investment advisor, but you're giving up all control over how that money is invested. And there may be higher fees to it. And finally, you could always hire an investment advisor. This gives you a more personalized investment management, but it's also the most expensive way to invest. So I think of it like flying. If you're buying individual stocks and bonds, you're like flying your own plane. People usually do it because they just enjoy it. They have fun. Not recommended for most people. Investing in a mutual fund is like flying commercial. That's how most people invest. The mutual fund manager is like the pilot of your plane. You have less control, but honestly, for most people, it's probably a good thing. And an investment advisor is like having a private jet. You get the best service, but at the highest cost. And I think where that makes the most sense is for someone who's got a lot of money in taxable accounts, where they want someone to help them with taxes, or if you just can't, emotionally do it on your own. You're just too worried that you're going to panic and sell out, and you want someone to kind of do some hand-holding, for you. Oops. Now, if you are investing in mutual funds, one thing I want you to be aware of is don't necessarily pick whatever the fund is that's done the best in the past. This study has been done over numerous time periods, and they actually update this all the time. And what they consistently find is that your chance of picking a top performer by picking what has done well in the past is pretty bad. Mutual funds don't tend to repeat high performance. So how do you know which mutual funds to pick? Well, the most consistent method to find the ones that are going to do the best are ones with low costs. And the lowest cost funds of all are called index funds. These are funds that aren't trying to pick the best stocks or bonds. They just buy all the stocks or bonds of what's called an index, which is a way of measuring different parts of the market. And because they're not trying to pick stocks and bonds, the irony is because their costs are so much lower, you can see on average 0.09% versus the active funds that are like closer to almost 1%. It sounds low, but that really adds up over time. And as a result, those active funds rarely do better than the low-cost index funds. And you could see the more funds you have and the longer the time, the less likely those active funds will perform. So you can pick an active fund and you might outperform, but statistically, you're probably better off sticking to low-cost index funds. Okay. If we had more time, I can go into all the theory as to why that's true. But for now, I just want to let you know that statistically, you're better off sticking with a low-cost index fund. All right, now this is probably the most complicated part, but the good news is it doesn't apply to a lot of people. This is only if you have investments that are not in your 401k, not in an IRA, not in an HSA, just a regular investment account. Because they're going to get exposed to taxes every time you have earnings. And so what first thing you want to do is use that for those investments that generate the least taxes, like individual stocks, if you buy individual stocks, ETFs, exchange traded funds, and mutual funds that don't trade a lot, like index funds. So that's another benefit of index funds. Not only are their costs lower, but their performance is higher. They also generate less taxes. Okay. If you have investments in a regular taxable account that have gone up in value, try to hold them for at least a year before you sell, because then you're going to pay a lower tax on the gain. If you have investments that go down in value, what you can actually do is sell them and use that loss to offset other taxes. Okay. It's called tax loss harvesting. The only trick is if you do that, you cannot repurchase the same or an identical investment within 30 days of when you sold it. So if you want to reinvest that money, you just have to reinvest it in a different investment or wait past that 30 days. Okay. And if this is really complicated and you have a lot of money in taxable investments, that's where I was saying it could benefit you to work with an investment advisor who can help you manage those taxes. But at the very minimum, I want you to just be aware of some of these tax implications. All right, we talked about a ton of stuff. So what I want to do now is just kind of review some of those next steps. The first thing I would do is use that retirement calculator, the one that I put in the chat box in that link. Plug your numbers in to see if you're on track for whatever goal you have. And if you are on track, maybe you want to be a bit more ambitious, right? Maybe you want to have more money in retirement, or you want to retire earlier. And if you're not on track, maybe see what you can do to get on track. If you need to save more, make sure you're taking advantage of all these different tax advantaged accounts, like your employer's retirement plan, HSA if you're eligible, IRAs, and then make sure your investments are reasonably diversified. You can do it yourself if you know how to do that. Or if you don't, you can just pick like a balanced fund or a target date fund that will do it for you at pretty low cost. Okay. Or you could decide to hire an investment advisor as well, especially if you want help with the taxes. And then review your progress each year and rebalance if necessary. Okay. So the good news here is, I think really most of that work is just that first step, right? A little bit upfront, but once you got everything set up, a lot of it can just go on autopilot. Just continue to save, continue to contribute, continue to rebalance. Don't let yourself, get thrown off track. I think one of the biggest mistakes people make, especially when it comes to the investment side, is they start playing with their plan, right? Either things aren't, like if the market's not doing well, they panic and they want to take money out. Or if something's doing really well, then they want to be too aggressive. They put too much money in something that's probably near its peak, or too risky. If something is really high returns, it can also have really high losses. So the idea is to just, stick to your plan, keep it simple. If you want to have some play money, to invest in something more aggressive like crypto, that's fine. But I certainly wouldn't want to bet my entire retirement on something like that. So those are some next steps to take. I know I covered a lot of stuff in a relatively short time. So what I want to do is make sure we do have time for Q&A at this point on anything that may have been a little confusing, maybe something we didn't get a chance to cover. Feel free to submit your questions through the question box. Let's see. So again, any questions, anything that we've talked about, or something we didn't get a chance to talk about that you may be curious about? Okay, it's like we got something coming in. All right, question, should we consolidate private student loans? Okay, good question. So now, usually when people talk about consolidate, they're talking about the federal loans, because there's a federal consolidation program, but you can also do that with private loans, right? Basically by refinancing it. So if you can get your loans at a lower interest rate with private loans, that's just beneficial for you, right? You may be able to get your payments lower, which frees up more money that you can use for things like saving for retirement. So it definitely can be a good idea. The one thing I would warn you about is refinancing federal loans with private loans, because when you do that, you lose some of the unique benefits that you get from federal loans. And so you just want to be really careful, about doing that. But yeah, if you are just doing private loans and you can refinance it, get it to a lower interest rate, maybe get them consolidated into one loan, that can be very beneficial. Other questions? Good question. Thank you for your presentation today. In an aggressive portfolio, what percentage would you recommend having in ETFs versus individual stocks? Okay, that's a great question. So there's no real answer to that, because there's pros and cons to it, right? So the thing about individual stocks is they obviously give you more control over what you're investing in. If you're in a taxable account, you have more of an ability to harvest tax losses. Okay, there's no management fees you're paying. The problem with individual stocks is they're a lot riskier, because an individual stock can go to zero and never come back. So you want to have at minimum 20 to 30 different individual stocks. You probably want to have more of that. You also want to make sure you're diversified in different industries, different sectors. So it takes a lot of expertise to make sure you're properly diversified with individual stocks. It may take a lot of money to do it. It's more complicated, it takes more time to manage. And so that's why people often use ETFs. Those are the exchange traded funds, because with that, you're diverse. What you get with that is instant diversification. You can buy hundreds, even thousands of stocks in one ETF. And they don't tend to generate a lot of taxes, and the fees tend to be very low. So there's no right or wrong answer. There are people that have all their money in individual stocks and bonds. There are people that have everything in ETFs, or some people have a mix. It just depends on your level of expertise and how much time you're willing to dedicate to it. All right, we got another question here. Outside of a company 401k, individual IRA, individual stocks, bonds, mutual funds, and real estate, what are the other good options out there for investing? Well, I think those are pretty much all the ones, right? That's what we talked about, right? Your company 401k or 403b, because you can get a match, you get tax benefits. IRAs, you get tax benefits. Individual stocks, bonds, mutual funds, real estate. Those are all the different areas. Those are the core ones, I would stick to. So I don't know that there's anything else. I mean, there are things that you can do that are a little bit more speculative, right? So crypto would fall into that. Gold would fall into that. And so that's a little harder to know. Commodities, there's more risk there. So I wouldn't want to put too much in any of those alternative investments, so to speak. Also be careful about using life insurance as an investment, because there are a lot of high fees associated with it that you just want to be aware of. Question, how do you determine when it is advantageous to create an LLC/Corp or rental property business? So I would definitely talk to an attorney about that, right? A real estate attorney, maybe an estate planning attorney, because every state is different when it comes to the pros and cons of using an LLC. It's basically a way of limiting your liability with real estate. Another way to do it is to get umbrella liability insurance to protect you in case you do have a lot of assets like real estate. Question, any particular advice for those of us who are self-employed? Great question. So if you're self-employed, you're not going to have, an employer with a 401k or 403b, but you can set up one for yourself. There are these what they call solo or individual 401k plans that allow you to put away even more than you can with one through an employer. like over $50,000 a year, potentially, depending on how much income and profit you have from your business. So that's one thing. Another thing is that, of course, you can have a lot of risk when it comes to cash flow. You could have some years your income is a lot lower than others. So it's even more important to have money in an emergency fund. Actually, it's important for everyone to have an emergency fund, because even if you don't have your own business, you always have the risk of, being in between jobs. And so you want to have enough emergency savings to cover at least 3 to 6 months of necessary expenses. And that could be even more important for someone who has their own business where your income could be volatile. So that's why a Roth IRA is great, because if you remember with a Roth IRA is you can access the contributions anytime you want without tax or penalty. So a Roth IRA can be part of your emergency fund. Also with a 401k, like if you set up a 401k for one person, as a self-employed, you could take loans against it too, to help you in case you need cash. So those are the two things: being aware of the 401k for one option, and also just making sure you've got emergency savings. Question: is there a benefit to maxing out the IRA or 401k versus investing elsewhere? Absolutely, it's the tax benefits is the main thing. Remember, with the IRA and the 401k, you're either lowering your taxes now if you put money in pre-tax, or with a Roth, that money can grow to be tax-free. Either way, you're lowering your taxes, either now or in the future. So those are pretty significant benefits. The only reason not to do them is if it's money that you really want for a different purpose. Like maybe it's not retirement money. And so like there are different accounts you can use to save for education expenses, or just a regular savings account for like emergency money, or to save to buy a home or something like that. But yeah, especially for retirement, you probably want to make sure you're maxing out all those accounts before you put money just in a regular taxable account, especially the Roth IRA. Because remember, the Roth IRA, you do have access to all of your contributions anytime without tax or penalty. Question: when is life insurance or indexed life the right choice? Well, life insurance, let's separate that. Life insurance is particularly useful if you have dependents, anyone financially independent on you, like children, or if you have a non-working spouse or spouse with a much lower income, or maybe you just have a large mortgage and your spouse couldn't afford to pay the mortgage on their own. That's when you'd really want to have life insurance. Index life is when you start to treat it more like an investment. So I'd be careful about that, because again, at very minimum, I would say to max out your IRA, 401k, everything like that before you start using life insurance as an investment because of those higher costs. Question: do you recommend high yield savings accounts? Yeah, high yield savings accounts are great for short-term needs, like emergency money, money that you plan to use to buy a home in the next few years, because you don't have to worry about risk. Okay, they're not going to lose value. At least they're not going to go down in price. Now, the downside is, even though they're called high yield, right now, because interest rates are so low, they're not paying a whole lot, right? A lot of them paying less than 1%. And the real danger is that they may earn less than inflation. So if inflation is running 2 or 3%, so if the prices of things are going up 2 or 3 percentage points a year, and you're earning less than 1% of your savings account, then you're losing a little bit every year of real value. And that's why in the long run, savings accounts are not so good. So you probably wouldn't want to use it for like your retirement money, but it's great for short-term needs. Other questions? Anything else? I've had a lot of great questions so far.
Well, Erik, I think we're done with questions, but lots of great questions, lots of good conversation, and of course, as always, a really wonderful presentation. So thank you so much for taking the time to do this for us today.
Thank you, Megan. Actually, there was one more question that just came in.
Oh, there we go. There it is.
Let me just address that one. So it says, do any of these methods affect credit? So no, the only thing that's going to affect credit is something involving credit, right? So if you're taking a loan, especially if you default on a loan or late on a payment, or if you have too much credit, right? All of that can affect you. So everything we've been talking about has been about investing and saving. The only way it would affect your credit is when you pay down debt. I should point out that does help your credit. But other than that, yeah, none of this would have an impact on your credit. So with that, I want to thank you all for coming. I really hope this was helpful.
We have one more question that's coming in.
Another one, see? Once we start telling people that it's going to end, then questions come. All right, question. Thoughts on zero expense ratio index funds? So yeah, this is very new. Now you've got index funds that don't charge any fees at all. And that's great. You know, there is a price war going on right now in the mutual fund industry where they're competing to see who can charge the least. And so the lower, the better. And the reason they do that, by the way, is what they're hoping is if you put money in those no expense ratio index funds, then you'll probably also put some money in other funds that they have that do charge fees. So in case you're wondering how that's profitable for them. But yeah, take advantage of the price war. It's hard to beat zero. Okay, well, thank you.
Thanks, Eric. We really appreciate it. Thank you for taking the time. Thank you for all of you who joined us for today's event. Hopefully you got some nuggets. Hopefully you have some more tools in your tool belt to be able to make some more financial decisions for yourself or for your family moving forward. I have up on the screen a list of events that are coming up. So while you attended the event to here today, we also invite you to join us for many events we have coming up down the line. So that includes some New York Terror Club events, that includes some non-New York Terror Club events, and both virtual and in person. While the Delta variant is causing some sort of hiccups in trying to get people together safely, we are hosting events that are outside to make sure that people can still build the community, but do it in a safe way. So on this listing, you're going to see a couple of alumni spotlights. Those are virtual. The Founders Chapel Choir Connection is virtual as well. But you're going to see a couple on the right side, some in-person events for where you live. If you joined us and don't live in New York, we have a couple of other events that are coming up in San Francisco, in Chicago, as well as Minneapolis and St. Paul. And we hope you'll be able to take the time and join us there. Thank you once again to Eric and to Christina for their work with the New York Torero Club. And thank you all for joining us. We hope you have a good rest of your day. And take care, everyone. We'll send you out some more information in the thank you email as well. Have a great rest of your day. Thank you.